essentially saying inflation does make a lot of sense to be pricing in right now. We have growth slowing on a trend basis, inflation accelerating on a trend basis. We have growth lower than consensus on over the medium term. We have inflation higher than consensus over the medium term. A couple things I'll say on the growth side, starting with growth. Our growth projections, which are a purely statistically derived autoregressive process, does not factor in things like Doge or rate hikes or any sort of positive or negative catalyst. How the model deals with those things is it now casts itself. It adjusts the new base rate when the data actually impacts when those fundamental dynamics actually impacts the data. And so what will ultimately happen is if we're right on our views on growth, then the blue line will just transpose itself down throughout the year. It'll keep the same curve, but it'll transpose itself down as GDP data are reported lower than expectations. And we're expecting that. We're expecting growth to come in lower than what our model is currently projecting, which it is already lower than what consensus is currently projecting. So that's a double negative. One thing we continue to highlight on the inflation side is, we were alone a couple of months ago in calling for core PC inflation to accelerate in 2025. Wall Street consensus had core PC inflation linearly decelerating. They were out to lunch a couple of months ago, just linearly decelerating. They've since revised up their inflation, core PC inflation targets alongside the Fed. Maybe they're following the Fed. I don't know why they're following the Fed. The Fed is following us. They should follow us and use our model, or at least our projections on inflation. So the consensus is getting more negative on growth. They're getting more positive on inflation. And they're not negative on growth enough, in our opinion, and they're not positive on inflation enough. And that represents market risk over the medium term in the direction of maintaining the current inflation market regime. So just be aware of that. It doesn't mean we have to price in an inflation market regime. It's just that when you isolate two of the more important factors for determining the market regime, growth and inflation, they're telling you that we should probably be pricing inflation. But again, these aren't the only factors that determine the market regime. There's liquidity, there's monetary policy, there's fiscal policy, and then positioning can be an accelerant when one of those cycles inflects. So just be aware that we got to piece this entire puzzle together. We can't just, bury our head in the sand and only focus on growth or only focus on inflation or only focus on liquidity like some people on Twitter want you to do. It's more than that. It always is more than that. The people who only focus on liquidity are just they're selling newsletter subscription. That's their goal, is to get you to talk about things that you care about. And if they convince you that they know more about the thing that you care about, you're going to subscribe to their newsletter. But that doesn't mean that growth and inflation don't matter. It doesn't mean the Fed doesn't matter. It doesn't mean the fiscal policy and the whole rewriting of trade policy doesn't matter to asset markets. It does, obviously. And I think people are going to find out this year why and how. Keep moving here. We use our global liquidity monitor to now cast the leading indicators of private and public sector liquidity across geographies. And by the way, we talk about liquidity as much as anybody. I think we have a great handle on liquidity. I would put ourselves in the top 5 globally in terms of understanding these liquidity dynamics, in terms of, at places where you can actually go buy the research. I'm sure there are plenty of people who are a lot smarter than me on this stuff. But the reality is you can't buy their research. They're sitting at some hedge fund somewhere making money off their intellect. And so what we're trying to do is, democratize that level of intellect and give you, consistent, accurate, and actionable signals on these types of dynamics. And right now, our liquidity proxy continues to trend lower across the global economy. It's trending lower in Australia, it's trending lower in Brazil, trending lower in Canada, trending higher in China, trending lower in the Eurozone, trending lower in India, trending higher in Japan, trending lower in Switzerland, trending lower in the UK, and trending lower in the United States. So liquidity, when you actually, when you kind of adjust for the fact that the dollar moves on a daily basis, which will impact any sort of dollar aggregated dollar-based metric, when you adjust for that, liquidity is actually going down on a trend basis. So investors need to be aware of that. You can kind of see this here. Black line in this chart is our global liquidity proxy. The blue line is global stocks, and the Bitcoin orange line is Bitcoin there. And as you can see, our global liquidity proxy tracks global equities and Bitcoin like a glove. So I think we know what we're doing here when we talk about liquidity. And right now, our model is currently signaling liquidity is currently trending lower, as you can very clearly see in the chart. It's currently trending lower. And our key leading indicators of global liquidity currently signal a modest uptrend over the medium term. We need something way more than a modest uptrend. A modest uptrend is not going to cut it in a year where we have a historic acceleration in global debt refinancing demand. So we need to see a significant uptrend in global liquidity over the medium term to have positive outcomes in asset markets. And I'm not so sure we talked about last week that we're not getting the liquidity on a prospective basis. We're not seeing enough liquidity creation on a prospective basis to prevent the global refinancing air pocket. And what we learned from the Fed this week is that they're not going to be proactive enough about it, at least not yet. So let's unpack that. So the median, sorry, my apologies. Let me get a sip of water here. Lots going on. All right. The median FOMC member currently views the net impact of President Trump's economic policies as a structural headwind for growth and a transitory tailwind for the unemployment rate and inflation. As you can see, they took down their growth forecast for 2025, 2026, and 2027. They took up their unemployment rate forecast to 4.4% in 2025. By the way, we're at 4.1% now, so the Fed's not going to panic until we get to past 4.4% before December. That is so negative in the context of needing them to supply liquidity proactively. If they think growth is going to slow and they think the unemployment rate is going to rise, and it slows and unemployment rate does rise, then what if they're not doing QE now? Why would they do QE when the things they expect to happen? That you need to have worse outcomes than this for them to go, oh no, wait, we actually do need QE, and we're more than likely to get worse outcomes than this if we're right on this kitchen sinking thesis that we created back last fall. They took up their headline PC inflation forecast for 2025 and 2026, and they took up their core PC inflation forecast quite substantially to 2.8% for 2025. So the Fed's just catching up to where we've been for months, for quarters, really. We've been signaling stuff for quarters, and so we'll see. But ultimately, what we've learned, in our opinion, from the change in the SEP projections is that they're probably going to be late because they're already expecting a growth slowdown. They're already expecting the unemployment rate to rise to another 30 basis points, and that's a problem. The median FOMC, as I mentioned, negatively revised their 2025, 2026, and 2027 real GDP forecasts. The number of FOMC members reporting higher uncertainty regarding their GDP growth forecast continues to rise. It's the biggest shock higher in this the number of FOMC members reporting a higher uncertainty regarding their growth forecast since COVID. The median FOMC member positively revised their 2025 unemployment rate forecast. The number of FOMC members reporting higher uncertainty regarding their unemployment rate forecast rose by the fastest pace since the COVID crisis. The median FOMC member positively revised their 2025 and 2026 headline PC inflation forecast. The number of FOMC members reporting higher uncertainty regarding their headline PC inflation forecast continues to rise. At 17. The median FOMC member positively revised their 2025 core PC inflation forecast, big jump to 2.8%, and the number of FOMC members reporting higher uncertainty regarding their core PC inflation forecast continues to rise. So a lot of uncertainty there. Reminder. Sorry. Reminder. The Fed has 700 to 800 PhD economists and 12 regional banks that survey 9 to 1,200 industry contacts for each beige book. Their uncertainty is consistent with our widest ever distribution of probable economic outcomes guidance and signals growth may slow much faster than consensus expects. This is, one of the three core pillars of what we do here at 42 Macro from an institutional macro risk management perspective are regime segmentation, Bayesian inference, and using volatility as a leading indicator for price. One of those three pillars is Bayesian inference. And I'll read you a quote from one of my favorite books, Thinking Fast and Slow. Subjective confidence in a judgment is not a reasoned evaluation of the probability that this judgment is correct. Confidence is a feeling which reflects the coherence of the information and the cognitive ease of processing it. It is wise to take admissions of uncertainty serious, but declarations of high confidence mainly tell you that an individual has constructed a coherent story in his mind, not necessarily that the story is true. And so the reason we wanted to highlight this is because going back to what we just talked about, the FOMC members, the pace and the level and pace with which they're reporting uncertainty regarding their growth forecasts, their inflation forecasts, and their unemployment rate forecasts is alarming, in my opinion, given that they have 700 to 800 PhD economists working for the Fed and 12 regional banks that survey 900 to 1,200 industry contacts for each beige book. If these people are uncertain, what do you think business leaders are doing right now? What do you think investors should be doing right now? If people with this much information and this much ability to forecast the future, or the perceived ability to forecast the future, are telling you that they're as uncertain as they've been since the COVID crisis, that should tell you that there's probably going to be some brake tapping in the economy on behalf of the leaders of on behalf of corporate executives, on behalf of consumers, and as it relates to making big ticket purchases and items. Who in the world is going to buy a car or a house right now with so much uncertainty? I mean, I guess if you need one, you're going to buy one, but if you could wait, if you have the ability to wait and to see what the tax deregulation package is going to be, see what the impact of tariffs is going to be, you will wait. And that's a problem in the context of actually having these headwinds that are tariffs, headwinds that are restricting immigration and slowing labor supply. And obviously the base effects themselves, 2 consecutive years of 3% real final sales growth is a difficult comp in an economy that has a fiscal retrenchment problem. So I want investors to know that growth may slow much faster than consensus expects. So if you see a technical recession develop in the first half of 2025, A, that's not priced in. And B, you heard it here first. What we learned from the White House Trade and Manufacturing Czar, Robert Lighthizer, this week is that the Trump administration is serious about fixing this toxic imbalance. This is the most important chart in the world. I've been saying this since I first created the chart back in the mid, I don't know, probably like 2013 or 2014 when the chart was down here. It's actually gotten worse. And so the blue line that I'm drawing on is the labor share of national income. If you look at nominal employee compensation divided by gross domestic income, the red line is the capital share of national income. If you look at corporate profits divided by gross domestic income, we used to be down here on a consistent base. We had this very healthy social contract in America where labor got X and the corporate fat cats got Y. Well, ever since we had a series of terrible policies, according to Bob Lighthizer, NAFTA, China joining the WTO, giving it most favored nation status, not having adequate protections for our domestic industries and American workers. And now we have this toxic situation where the average American person is living shorter than their parents, living shorter lives than their parents. The average American person is making less money than their parents did at the same level, same age. And they're obviously starting homes at a lower rate. They're getting married at a lower rate, and they're having less kids. The American dream is dying right before our very eyes because of this chart. And if the Trump administration is serious about correcting this toxic imbalance, then that means the blue line has to go up and the red line has to go down. And if the red line has to go down, that is not at all factored into current valuations of equity and credit markets at all. And so when we keep saying, hey, if they're trying to transition us from paradigm A, which is this, where the big globalists and the corporate fat cats won the game, to something where they're going to start to lose the game, that's not priced in at wherever the price is of the S&P 500 or whatever price of Bitcoin is right now. It's just not. And so I want investors to be aware of that. Don't take this stuff. Don't be dismissive about this stuff because it seems like they're very serious about fixing this toxic imbalance. Lastly, we view 1998 as the best analog, as the best market analog, where President Trump kitchen sinks the U.S. economy and ultimately forces the Fed to print. So what happened in 1998? We had a very swift crash in the market. We had a retest of the lows a couple of months later, and then we was off to the races. We recovered the highs within 3 months, and we were up, 25% or 28% from the lows of August 31st through the end of the year. But again, we had to crash to get to those lows. And so I continue to think this is the most likely scenario for asset markets is we have to price, the markets have to acknowledge that we're going from paradigm A to paradigm B. And you don't jump to paradigm B like we talked about a few weeks ago. You have to go, when you're on the top of one mountain, you don't jump to the top of another mountain. You go down the mountain, through the valley, and up to the next mountain. And that's our core fundamental belief. And if our core fundamental beliefs are wrong, then Kiss and Dr. Mo will do what they always do, which is say, hey, Darius, we're better at investing than you are. Change your allocations to this. And so just be confident that Kiss and Dr. Mo, no matter what I think is going to happen and what I think is priced in, is irrelevant to the positions that you're going to have in your portfolio, because we ultimately know that Kiss and Dr. Mo are much better than me at predicting where asset markets are headed. And we're really grateful for that. So we'll wrap it up there. Everyone have a wonderful weekend. We'll catch you back here next week. Cheers.